So I don't know if you noticed since the last update I gave you about Bitcoin and the altcoin markets, which was yesterday, about what, like 12 hours ago. Um, the assets that were in mean reverted, like Bonk, for example, on the 4 hour time frame, completed their mean reversions to the 3012 RMLR, whichever RMLR they were mean reverting to, as expected. You know why? Because the probabilities, that's why. So, are you shocked? I hope not, because the fact that assets mean revert is just a fact of the maths, right? It's not, shouldn't surprise anyone, like at all. So, surprisingly, there are some people who are shocked by that. Well, maybe it's not so surprising because they don't know about mean reversions and they don't know about the RMLR. Now, what else has happened in the meantime? Well, Bitcoin has hit yesterday, obviously, the third band to the downside of the 1110 RMLR, and since then has not hit it. What does that mean? Well, it means it's had a few candles of not hitting it. What does that mean? Well, it means it's in, stay with me, folks, mean reversion to the 1110 RMLR on the 4 hour, which is currently up and around like 104,300 or something like that. A couple thousand above where it is, basically. At least the last I saw the prices, maybe about a half hour ago or so. So, yeah, there are assets that have completed mean reversions to the downside, assets that have punched downside STDEV bands like Bitcoin, and now are in mean reversion to the upside on the 4 hour. And there are also assets like on the daily that have mean reversions to complete. And there are other assets that have even, well, there's always lower time frame assets that have mean reversions, right? That happens quite regularly. If you look at the 15-minute and under on any given day, there's going to be mean reversions. You know, distributions happening that hit an STDEV band, and then mean reversions are at play. That happens practically every day on so many different assets, especially in crypto, right, where you have pretty volatile movements. When you get down to the really low time frames, like anything under 15-minute, 9, 6, 3, 1, etc., you tend to have a lot of those. You know, you tend to have a lot of those. 30-second, whatever. And why? Well, for the very simple reason, right, that with the lower the time frame, usually, even though the bands are relatively proportional to the height of the candles, right, by the definition of the maths, right? So when you have fairly tight bands on lower, because on lower time frames, so that means that the assets don't have to move as much in real, you know, in a total number or in a pure number, as opposed to a percentage, right? And or even as a percentage, they don't need to move as much as an overall percentage of the total value of the asset in order to hit an outer band. So you can easily have an STDEV band on a 30-second, a 1 minute, a 3 minute, and, you know, maybe a 9 minute, it'll skip the 6 minute for some reason or whatever. And then, you know, but not on the 15-minute or higher at the moment, right? Or, you know, some combination there, right? Or you might only have an STDEV like on the 30-second or on the 1 minute and not on other time frames, you know, all the way up to like the 15-minute or half hour or 33 minutes. They'll all be mean reversion free, while the one on the super low time frame is mean reverting. And that happens a lot, right? But when you find confluence, when you find that there is a mean reversion happening on multiple time frames, that is extremely useful, right? Especially when they're in the same direction, right? Because then you can look for them, one to kind of lead into the other, right? Usually you'll have the lower time frame one complete first, but not always. But usually it does go from the lower to the higher, and then the higher, and then the higher after that. The highest will always be the one that in theory will take the longest time to complete, just because of time frames. But it's not always the case. It can be that they happen at pretty much the same time, especially if you have a very powerful move that smashes through. But usually, what happens is the lower time frame one will happen, and then one after that, a higher time frame one, and a higher time frame one, and so on, until they run through all of them. Now, when they go in opposite directions, well, then you have very interesting information to look at, because it could be that it's going to do the lower time frame one first and then the higher time frame one, or it could be that the higher time frame one is actually more likely to finish first and then complete the lower time frame one, right? It all depends on the setup. It all depends on the information. Where is the asset in reference to or relative to the areas that it has to mean revert to? Right? Does it have to go very far to complete the mean reversion, or can it just go a tiny little distance relatively? So that's kind of what you got to look at there. Doggos. I like the doggos. By the way, anybody yet guess what these crops are? Before I tell you what they are, one of these days, maybe. I wonder if you can tell. I'll zoom in for your benefit. Can you tell what those things are? No? Rows and rows of tall, green, leafy, harvesty crop. Very tall, very leafy, very harvesty crop. Can you see? Can you tell? I wonder when you'll be able to tell. Leave a comment in there. Write your answer in the comments or something like that, if you know. So mean reversion, right? That's what's happening right now. And again, when you have them happening on different time frames, it gives you very nice opportunities to operate in different directions. Now, here's the thing. Some exchanges will allow you to open positions in different directions, even on the same account, right? Like you can open a long on Bitcoin and a short on Bitcoin, and they'll be separate positions, right? For some reason, you might want to do that, right? For example, if you believe that short term it's going to dip and then longer term it's going to go up, but you believe, whatever reason, that now is a good time for you to open up both those positions. Some exchanges will actually allow you to do that. Some exchanges will not, and they will combine your positions, right? So if you open up a long and a short, and they're of equal value, basically you've opened up no position, right? If they're off even by a penny, then whichever one is the greater value is the one that you will see as the open position, right? And that's, frankly, more and more exchanges are doing that and not letting you open up contrarian positions. There's a reason for that. And it's arguably a silly reason, but it's a reason. But there are exchanges that do let you do that. But more importantly, there are ways around that. So you wanted to, for some reason, open up, I don't know, like if you're a longer term, person, trader, or whatever, and you wanted to open up a position that's to the downside for the short term and then to the upside for the longer term, just as an example, there are ways to do that on different exchanges, even if they don't let you do that in the same account. So some exchanges will let you have multiple accounts, especially those that don't do KYC. Some exchanges, so like DEXs and stuff, obviously you can do that on a DEX if there's no KYC on the DEX. Other exchanges will let you open it up in a sub account within the same account, so you can have multiple accounts. You could have one for longs and one for shorts, or whatever you want to do with it, right? Or you just in that moment create long in one account and short in the other. A lot of exchanges will let you do that. Some will have assets that are very similar to the one you're trading. Like, for example, something like a wrapped Bitcoin as opposed to a regular Bitcoin, and the price might match 1-to-1 the regular asset, right? On an index chart or whatever chart they have there that they're using, or their own exchange chart. So it really depends on the exchange. That's why it's good to familiarize yourself with whatever exchange you're using, right? And generally speaking, it's good to use or to have accounts on more than one exchange so that you can easily roll in and out of different exchanges. Let's say, you want to trade Bitcoin on one exchange today and on a different one tomorrow, and a third one on the next day, and a fourth one on the next. You might want to have even 7 exchange accounts, right? So that every day of the week you trade on a different exchange. Now, while that may sound crazy, it's not. If you're trading low time frames, if you're taking your assets off of the exchanges when you're done with your trading sessions. Now, I know a lot of you guys watch YouTube Jimmys, and you think, oh, I'm just going to leave my swing positions open here and let her ride because I got in a good entry, many thousands of dollars ago, so I'm good either way. Okay, maybe you're in a good position. Maybe you are swing trading it. Maybe you're just going to let it ride and see how far this bull run goes. But just keep in mind how many exchanges have gotten, attacked over the years, and funds have been drained, and traders' positions have been closed, and they've lost all their trading positions, and they did not get their money back. It's happened a lot to a lot of traders on a lot of exchanges, and the likelihood that it will never happen again is practically zero. And the likelihood that it will happen again is practically 100%. Why? Because it's happened a lot, right? Not every exchange has the world's best security by definition. Not every exchange has the world's best liquidity pools by definition. Not every exchange has the world's best, backup systems by definition. Not every exchange has the world's best reverse hackers who can trace where the funds went, and the world's best negotiators, and the world's, who can negotiate with the hackers and get the funds back, etc., etc., etc. Right? By definition, not every exchange can be the best. Therefore, they can't all guarantee it. Therefore, the probability of actually losing funds during such an attack is increased, not decreased. And you could say, well, then, Yasha, why would I use anything except what is considered to be the world's best exchange? Well, that's a very good point. You could go the route of trading only on something like a regulated exchange, But guess what? Coinbase may be a regulated company, but crypto isn't regulated. So if God forbid they get, hey, hi, hey Matt. So if God forbid, the exchange, the Coinbase or something gets attacked, yeah, their company might be regulated, but it doesn't mean that their crypto trades are all protected 100%, right? In fact, the opposite is true. But their crypto accounts may very well be unprotected to some degree. They may tell you that it's protected, but in reality, there's no regulation on crypto in the United States. Right? Now, they may have in place rules and regulations that say that you're in theory protected, but in reality, you're not. Anyway. All right, folks, I got to go. So happy trading. Stay safe. Peace.